Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about mutual fund basics. Seems to be that most people who start investing that we see typically get involved with mutual funds. Additionally, most corporate sponsored plans such as 401ks and 403bs at times do have mutual fund holdings within them. And then, of course, you have some very well-known investment, executives that have been around for years and years and years. You have Warren Buffett, who made his money mainly in single stocks, but said at the time of his passing that he's going to refer to have his wife move the money into index funds. So mutual funds are used by a lot of people for investing, and there's a lot of reasons why. So we're going to talk about the basics of mutual funds, what you should look out for, and then we're also going to talk about some of the pros and cons to them. So the first thing we're going to do is just talk about the basics. What really is a mutual fund? Ty, do you want to start out with what we should look at here and what the basics are to identify a mutual fund?
Yeah, Dean, and when it comes to mutual fund basics, we find that this is going to be a show that it applies to anyone, whether you're a new investor, you're younger, you're just starting out, or you've been working for 40 years and you have a 401k. And the reason why is because more likely than not, at one point in your life, if you contribute to any sort of retirement account, you will potentially have access to a number of different mutual funds. Because again, any type of 401k, 403b, many types of different corporate sponsored retirement plans, they primarily hold mutual funds as your investment option. So if that's going to be one of your main wealth building strategies over the course of your working years, it's important to know exactly what it is then that you're going to be investing in and what it is that you are going to accumulate wealth in over all those years. And again, mutual funds are the most common when it comes to any type of retirement account. So within a mutual fund, basically what a mutual fund is in simplest terms, it's like a basket of single stocks all into one. So it's a basket of a whole bunch of different single stocks, anywhere from 50 to 100 to up to 500 plus individual stocks that one particular mutual fund can hold. So we're going to get into some of the advantages later on in the show, but as you can probably realize, buying one share of a mutual fund allows you access to a number of different individual stocks. So first off, you can really diversify with a low investment amount. The other thing, one of the main characteristics about a mutual fund is that it's typically managed by a fund manager. And what that is there are mutual funds are assigned portfolio managers. So it could be someone on Wall Street who their job is to buy and sell some of those different stocks that the mutual fund is made up of. So their sole job is managing it. It's managed. Those stocks typically don't just sit there. They are bought and sold by a fund manager. And in addition to being managed by a fund manager, mutual funds, they do have fees. And part of the reason why is because they are managed by a fund manager that needs to get compensated. Mainly two different types of fees. The first one being a load or a commission. Many times it's referred to as a front end load or back end load, which is a commission, meaning if you were to buy some types of mutual funds, you pay anywhere from 2 to upwards of 5% up front when you first invest the money, and there's a commission that's taken off the front end load. And then in addition to that, there is something called an expense ratio. And an expense ratio is an internal fee that is taken out of your mutual fund each and every year to compensate the mutual fund manager. So there's usually two different types of fees within mutual funds, a commission and then an annual internal fee that you pay each and every year to hold the mutual fund.
Okay, Tyler, I want to throw something else out there while you're talking about expenses, just while I'm thinking about it. This is something that you need to pay attention to your statement that you get if you're holding mutual funds. Find out if you are paying a load or a commission. So in this situation, you typically see it with, it's called A shares. So you might have a mutual fund, an American Funds Balanced Income A, Class A. And what that means, as Tyler said, you're paying a front end load, which is a commission. But if you're also paying an advisory fee to an advisor, we don't, I mean, that should be frowned on. I mean, it's a situation where if a commission is coming off there, definitely an advisory fee should not be in place. Another thing too is Tyler was talking about fund managers, and one place that we like to go to find out a little bit more about fund managers is go to Morningstar, or you can go to the actual fund's website to find out information. So as an example, I brought up American Funds because they're quite popular. If you went to Morningstar, you could find out some information on the fund manager. Has the fund manager only been there for 3 years? And out of the 3 years, what was the performance? Has the fund manager been there 25 years and has weathered the storm quite well and taken advantage of bull markets too? So you can do your history, look at the fund managers and find out their experience and how they have performed over the years also.
Yeah, good point there, Dean. A couple other last characteristics of mutual funds is one is that you can buy partial shares of mutual funds, whereas for single stocks you can only buy whole shares. So, for example, you can buy one single mutual fund with as low as $25. So, let's say the particular mutual fund that you want costs $50 per share. Well, if you only have $25 to invest, you can do that and you can get a half of a share of a mutual fund. So they allow partial shares, which is, again, it's very good for allowing people who might be starting off with not a lot of money to be able to invest and diversify and hold a number of different stocks within one mutual fund due to the fact that you can buy those partial shares. Whereas single stocks, they only allow you to buy whole shares. So if you want to go and buy a share of Apple stock, you have to have at least over $300 because Apple right now is right around $300 a share. So again, that's another advantage of mutual funds that we're going to get into later, but you can buy partial shares versus only whole shares with stocks. And then mutual funds, they grow similar to individual stocks and ETFs and other stock market investments, where the growth happens both through market gains and then they also pay dividends as well. And those are you can have dividends reinvested if you're younger, or if you're older or even younger and you want income, you can take those dividends as income. But again, with a mutual fund, they grow through stock market performance and through dividends are the different forms of growth. So again, just to recap before we go further in the show, mutual fund, it's like a basket of single stocks all within to one. They're managed by a fund manager, and that typically does require fees.
Okay, a couple of points we're going to talk about now is the types of mutual funds. The first one we're going to look at is an equity fund. So understand, before we get too deep into this, mutual funds can cover just a broad number of different investment perspectives. So for instance, for those people who want to carry predominantly stock, you can get a mutual fund that's called an equity fund. An equity fund would mean stock. So again, you could hold anywhere from 25 to 100 different stocks. Tyler brought up Apple as an example. For instance, you want to hold one share of Apple, you are going to pay $300 for that share because you cannot buy partial shares. However, if you buy an equity fund, mutual fund, you can go and maybe put $250 into this thing and own not only Apple in the portfolio, but 25 to 50 to maybe even 100 other companies like that. So equity fund is based on stock. Tyler, what else do we have here?
Yeah, Dean, so now when we talk about the different types of mutual funds, Every single mutual fund has something called a fund objective, meaning that it's what the objective is. It could be growth or income or preservation of capital. So when we talk about equity funds, those are simply mutual funds that invest primarily in stock. And it could be anything from primarily growth stocks. It could be small cap or mid cap stocks. It could be growth in income or dividend paying stocks. But it's all based on the fund's objective. So for example, equity or stock funds, they invest in stocks. You might have some of the stocks in there be Amazon, Apple, Microsoft, Home Depot, Procter & Gamble. So equity funds, they invest in stocks. Those are typically going to give you the most growth over the long term because, again, stocks outperform bonds or cash over the long term. So equity funds are made up of individual stocks. In addition to equity funds, there are fixed income or bond funds. Now, bond funds or fixed income funds are made up of individual bonds all into a basket. So again, you have access to a number of different bonds with a fixed income fund, and those are typically used for income or some conservative investors. Now, fixed income funds, they can still lose money, they can still perform poorly, but over the long term, they're going to be less aggressive, less risky than equity or stock funds. So this is something where we usually see as people get a little bit older, as they get closer to retirement and into retirement, usually the fixed income portion of their portfolio tends to increase a bit more because instead of having more allocated toward equity or stock funds, they shift toward fixed income because as you get older, you no longer want to take on that risk anymore. So you might give up some upside of the equity or stock funds to try and go into fixed income funds to try and get a little bit more stability and a little bit more of a cushion within your portfolio, so to speak. If we do have a big market downturn, the fixed income funds, they're not going to fall quite as much. In addition to the fixed income funds, we also have index funds, and these are becoming very popular. Many people are starting to hear of index funds. Index funds, what they do is they simply track a stock market index. So everyone hears of the Dow Jones, the NASDAQ, the S&P 500. You can go out and you can buy an S&P 500 index fund, meaning that you get all the growth of the S&P 500, but you also get all of the losses as well. So that's an easy way to just track whatever the stock market does. That's pretty much what you're going to get. One of the benefits to that is that they do have very low internal fees because there's no fund managers that manage index funds because all it is simply tracking the 500 stocks on the S&P 500. So an index fund is very cheap, convenient, easy way to invest in the stock market or to invest and get the gains that the stock market does. But many people don't realize that index funds also carry the same risk and the same losses with the market, where you don't have any protection within your portfolio. If you have everything in just an S&P 500 index fund, you're going to get all the gains, but also all the losses of the stock market. And then with index funds, they're typically called passive investing, where what it is you invest in, like I just mentioned, you invest in an index, you're going to get all the gains, you're going to get all the losses. There's no one that's actively managing the stocks within your index fund. Whereas actively managed funds, and a lot of mutual funds are primarily made of actively managed funds. That goes back to the fund manager that's actively buying and selling individual stocks within your account. So each one of them has their purpose. Each one works. There's not necessarily one that's better than the other, but there probably is one that's better than the other for you and your particular situation. It all depends on what you're looking for. But index funds are another one. In addition to index funds, balance funds are another type of mutual fund. Balance funds, just like the name implies, you have some stocks and some bonds. So balance funds are truly for the moderate investor. We see a lot of people that are closing in on retirement or just retired that have some balance funds, and what that does is it gives them upside and growth potential due to the stock allocation. But then balance funds also contain bonds. So it gives them a level of stability and a conservative portion within their portfolio as well. So balanced funds are something that are used, but we see by many pre-retirees and retirees.
Okay, Tyler, I just thought of something when you're talking about balanced fund, though. Many times we have people that are confused between target date funds and balanced funds. And balanced funds, as Tyler said, might carry 60% stock and then 40% bonds. And when they do get out of balance, they just rebalance back to that 60-40 or 70-30 percentage. However, target date funds, in a way, act like the balanced fund in that you have equity positions or international positions, and then you also have bonds. However, they have one other trait that they have in place with a target date fund, and that is, as you get closer to that targeted date that you anticipate as your retirement typically. So let's say you have 2025 as your target date investment, and there's a lot of companies that have them, Vanguard and Fidelity and so on. What happens is each year that you get closer, you tend to get more bonds or fixed income positions, which makes it more conservative. So again, don't get the balanced fund and the target date confused, even though they're relatively close. A balanced fund will rebalance back to the original percentage that you want, 60-40, 70-30, whatever it is you go into, where a target date fund will somewhat come out of balance to get more conservative in bonds and fixed income the older you get. So before we go on to the next type of mutual fund, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next mutual fund is really a money market fund. And Tyler, let's talk about what makes up a money market fund. A lot of people, I think, are a little bit confused about this too. They think it's cash sitting in their portfolio.
Yeah, Dean. The next type of fund is a money, like you mentioned, a money market fund, and that's mainly made up of treasuries. Those are government treasuries that primarily make up a money market fund. And with a money market fund, that's something that people use as a cash position. You can use that as a cash position within your 401k or within your IRA or Roth IRA within your portfolio. Or money market funds, sometimes they pay a little bit higher interest than you would get right now in a savings account at your bank or credit union. So money market is something that you could invest your emergency fund in. We're big advocates of having at least 3 to 6 months of living expenses within your emergency fund, and money market funds could be a good place for that. Something that allows you to have access to the money. It's made up of treasuries, very stable. But right now, based on interest rates, you're not going to make hardly anything at all on a money market fund. So just keep that in mind, that it's basically a holding spot for money that you might need access to. Or if you have someone actively managing your account, it's something that it basically sits there in cash, and then you can use that to buy in low if the market were to have a dip. So money market funds, very conservative, basically allows you access to the money, but you're not going to make hardly anything on the in terms of an interest rate on funds that you have in a money market position. In addition to money market funds, you can also invest in international or global mutual funds. And as the name implies, international funds are made up of stocks that are of international companies, so not based here in the US. Usually those are going to be riskier than US-based companies, just because there's so many different factors, such as the foreign exchange rates and the foreign markets, the economy in a different country. So those are a bit more risky. They're more aggressive than US-based stock funds, but with international funds, we still, from time to time, we do like international positions, but we usually don't recommend any more than 25% of your portfolio be in international positions. And then along with international positions, something that's becoming a lot more popular, the last two that we have here, types of mutual funds, are sector funds. Sector funds can invest in a particular sector. So, for example, technology. There are some people, myself included, who are quite bullish on the technology sector over the next 1, 3, 5, 10, 20 years, basically the foreseeable future and the long-term future. Technology is what has driven the stock market over the last decade or so, and we expect it to do so for the next decade. But if you don't want to go and pick individual tech stocks, you can pick a tech sector mutual fund that will invest in a number of different, up to 500 different tech stocks all in one. So you can get that exposure to a number of different tech companies through a tech sector mutual fund. But the same thing goes not only for tech, obviously. You can also invest in healthcare, pharmaceuticals, biotechnology. So there's many different sectors that you can invest in with a sector fund.
Okay, good points, Tyler. Before I forget, I want to go back to the international. In something you said there, with international, it does carry usually significant risk, a lot like pure equity funds. But with international, you don't have to just get a blanket international fund. You can get international that might focus on Europe. So if for some reason you feel you're very bullish on Europe, you can get funds that just focus on investments from Europe, Asia, South America, or you can get a blend, which is global. So do understand, though, even though you get into international or global, you do have some input on which part of the globe you're investing in, not necessarily the investments within that fund, though, as far as the companies. But Tyler, as far as that, sector funds too, healthcare, financial, tech, so on. And there's really one more that we want to talk about in that socially targeted funds. We're seeing more and more of these right now. And this is typically if you have an investor who just absolutely wants to invest in maybe clean energy. There are funds that deal with companies that are held in the mutual fund that only deal with wind power or hydroelectric and maybe nothing with fossil fuels. You can find socially targeted funds for somebody who wants absolutely no tobacco or alcohol, held in the mutual funds too. Tyler, anything else on the social targeted funds?
Yeah, Dean, just that the socially responsible or socially targeted funds, they are, as you mentioned, they're becoming a lot more popular. Typically we see it more so with the younger demographic, but Dean, as you mentioned, there could be a fund that has only clean energy, like no gas mining or drilling or oil companies. The other one could be a mutual fund that invests only in companies that are doing certain things for the climate and different things like that. So they're just called socially responsible or socially targeted funds. There were some studies that were done on those funds, and it just shows that people who, it kind of gives them more of an incentive to invest in things like that if it's something that they care about a little bit more. So that's something that's becoming a little bit more popular. But as we can see, when we went through the different types of mutual funds, there are a ton out there for you to choose from, which is good for the investor. But oftentimes we find that if someone has too many options, they might be spreading themselves too thin too soon. So it's important to sit down with an advisor and go through which types of mutual funds might be the best for you in your particular situation.
Okay, now to close out the show, we're going to talk about advantages of mutual funds and disadvantages of mutual funds. I'll talk about the advantages of the mutual funds, and then Tyler will close out with some of the disadvantages of mutual funds. So the first advantage of a mutual fund is diversification. We just spent the greater part of the show explaining the types of mutual funds. You can get significant diversification amongst equity funds, fixed income, index funds, balanced. You can also get great diversification within the holdings inside each mutual fund. So diversification is good. Diversification does not guarantee against market downside and volatility. You do spread out the volatility a little bit more amongst all of the holdings. So diversification is key. You hear that from a lot of investment advisors and in basic financial planning. The second thing is easy access. Mutual funds are very, very easy to start. Again, you don't have to buy whole shares. You can buy fractional shares of mutual funds. So again, for $250 or maybe even less, you can start out with a mutual fund. You can do it on your own. You can start your own retail account on, TD Ameritrade or Schwab or Vanguard Fidelity, and start with mutual funds there. You can buy them from a bank. You can go to a bank, and most banks have the investment corner where they'll get you started with mutual funds. And also, you can hold them within your portfolio through an investment advisor. Typically, though, if you're working with an investment advisor, you want to hold no load or institutional shares so you don't get hit with a commission. We talked about that earlier. You also get a professional fund manager. So if you're holding some American funds, as an example, you can go and see who the fund managers are by checking online, either at Morningstar or directly with the website of the fund itself. So you get some professionally managed decisions happening within your mutual fund. And then the last thing is just a wide variety and freedom of choices. Again, if you don't like a certain sector held in your mutual fund, if you're completely against, let's say, the airlines, you don't have to hold a mutual fund that has airlines in there. You can go to a sector like energy, you can go to healthcare and tech, as Tyler explained. So you have a wide variety and freedom of choice within mutual funds. So those are some of the advantages. Tyler, what about disadvantages?
Yeah, Dean, and then just to close out the show, some of the disadvantages from mutual funds are that they typically do have higher fees than ETFs or exchange-traded funds and single stocks. Again, as I explained earlier, the reason why is because there's usually a professional fund manager that needs to be compensated for buying and selling the individual stocks within the fund. In addition to the higher fees, they also have capital gains taxes and non-qualified or non-retirement accounts. So with that fund manager buying and selling stocks, that will oftentimes spit out a capital gain that if you hold a mutual fund in a non-retirement account, you're going to be taxed on every year. So they are a bit tax inefficient in non-retirement accounts as well. And then the other thing is that they do sell at the end of the trading day, so they don't trade like stocks. If you want to get rid of your mutual fund and it's 9 o'clock in the morning, if you go in to sell it, it won't process until 3 o'clock p.m. at the end of the trading day. So that's something where you take the full gains or full losses throughout the course of the day before you can buy or sell your mutual fund. And then the last disadvantage of a mutual fund is that there's a lack of input from investors in the particular stock selection within. So if you invest in a mutual fund that doesn't have Amazon stock and you want Amazon stock, you can't put Amazon stock into a mutual fund because it's professionally managed. You're at the mercy of whatever that fund manager chooses or doesn't choose. So those are just a few disadvantages of mutual funds, but we hope that our listeners got good information and just now know a little bit more about the mutual funds that you might be holding within your retirement account. Okay, that's all the time we have this week. See you later and hope you'll join us again next week. We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.